Hi everyone, thank you for coming today. My name is Paul, I'm the co-founder and CEO of Finexity, a company with the vision of creating capital markets 2.0, thereby creating a digital exchange that makes private market investing less private. Can I actually take this microphone? Can I use it? No. This makes it a bit easier. Great. I want to take you onto a journey today to talk a bit about the history of Finexity, where we come from, where we want to move to, and thereby give you a better feel for why we believe tokenization will have a massive impact on private market investing. And I think when you form a company, one of the major things is to create the why. And the reason why we created Finexity is to give every single investor, hopefully at one point, global access to private market investments. The reason being is very, very simple. KKR, one of the largest private equity companies in the world, did a back study. Did a study and did back testing and looked at what would happen to my average portfolio structure of that we know of Harry Markowitz that was formed in 1952, the 60-40 allocation between bonds and equities, and what would happen to the portfolio, meaning the expected return, but also the risk, so the volatility of it, by adding 30% private market investing. And what we can see from it is that not only the risk exposure reduced significantly, but also the expected return almost threefolded. However, one of the largest problems that we see in the private market investment space today is that it's very, very inaccessible to retail investors. Why? Huge information asymmetries, huge equity requirements. So if you want to invest into private equity, you've got significant minimums, even if you get an allocation. I mean, these days it's a bit easier because of the current economic situation that we're in when it comes to the interest rate spikes. However, nevertheless, you need to have the knowledge to do so. And then also there's obviously a lot of asset management required when it comes to tangible assets. And one of the key drivers of why it's really inaccessible to retail investors is the flexibility or the reduced flexibility. So there's not really liquidity in the market that makes it really difficult for retail investors to invest into the space. Let me see. Great. When we look at Finexity, some of you might know Finexity, others don't. We are quite popular in the B2C space. However, in the B2B2X space of what we've actually been building over the years, we are not very popular as of today. We were founded mid-2018. We reconciled with the BaFin on the business model for over a year and a half. That enabled us to launch our first tokenization project at the end of 2019, beginning of 2020. Ever since, we have issued on our ecosystem platform over 160 issuances. We have also 10 trading partners connected on a white label basis and over 10,000 registered users that either come through our own infrastructure in terms of being a broker or our trading partners. And what we've also done is that in 2021, June 2021, we launched the first OTC secondary market for the trading of tokenized securities, thereby obviously enhancing liquidity significantly for the investors. In 2022, and this is what the vision of what we're trying to carry today, is that when you start a firm, especially when you start a marketplace model, you always have the problem that you need to cater demand and supply at the same time. And that obviously makes it really difficult. So back in the days, what we said, rather than reaching out to large asset managers, we would create our own SPVs, we would purchase assets, refinance them through tokenized securities, but also do the brokerage side of things. So we would cater the whole value chain. That business model, in our perspective, is not very scalable. So what we did is that we opened up our platform infrastructure in 2022, where we've then proven over 3 years that this business model actually works. And today we cooperate with asset managers. They issue the tokenized securities. And on the other hand, we connect them with trading partners, in particular financial institutions and wealth managers that utilize our white labeled infrastructure to then broker them to their clients. In 2023, we have completed a strategic spin-off of the corporation and have started our expansion into the Middle East. There's been two major regulatory changes that have happened over the years while we were active that have given rise to our business model 2.0. One of them is the securitization of securities. I mean, back in the days, some of you might know this, is that you would like really back in the days when securities were still on paper. You would have the certificate, you would have the sheet, you would go to the issuer, you would hand them over the sheet, they would rip it apart and then give you your interest pay. Then we had the idea of a global certification that came into place in approximately 1972. And these days, in 2021, the Electronic Securities Act was introduced that has enabled both electronic securities but also crypto securities. That obviously had a massive impact on the institutional side of tokenized securities because these become more accessible. Because they are far more regulated than security token itself. On the other hand, the market infrastructure has become more regulated. And this is primarily what we're going to be focusing on in the next 15 minutes, is the DLT-TSS market operator model. The market operators these days obviously usually would be running an MTF. What has happened is that the MTS and you would have the security settlement system or like the clearing system not very much interlined with each other. This is enabled through the DLT-TSS is the first time in history where you as a market operator can be running an MTF but also do the settlement. And to us, this is one of the greatest game changers because this reduces a lot of the intermediaries that currently take cuts and take place in a lot of the financial transactions that are taking place, and thereby obviously raising efficiency for all of the market participants. So if we were to summarize now where we've come from, we came from a really traditional B2C business model, issuing, brokering, doing the asset management. We actually developed a self-custody solution back in the days for our investors. So we've really covered the whole value chain. These days, we're really focusing on cooperating with the asset managers, with the trading partners, financial institutions. And what we've done is create a whole ecosystem of players that are just utilizing our capital markets infrastructure to facilitate trades in two primary, I would say, different business objectives. So on the one hand, we cooperate with financial institutions primarily on the base of making regional developments financeable. So thereby, for instance, if we take the topic of we cooperate with the savings bank in Bremen, they bring in an asset that could be an elderly home. That elderly home is then funded through their own investment. They structure the issuance. They then broker it to their clients, and thereby we support the regional development side of things. On the other hand, we cooperate with asset managers. Those could be project developers. They bring in the asset, and then we link them up with the trading partners again. So this could be a wealth manager that would then sell it off to their investors, and thereby obviously providing the end investors with greater investment opportunities that haven't been accessible before. So when you look at the whole ecosystem, on the one hand side, as I spoke about it, we've got the issuers. These issuers, they're listing their securities on our ecosystem, on our trading facility. On the other hand, we connect them to the trading partners. These are either connected via a white label solution or an API. The API is quite funny because a lot of people obviously think, okay, this should all be interconnected. We've never ever added a trading partner that's actually asked for an API because of their technical capabilities. So we went out and we tested this before we launched this, and they said, well, for us it's a lot easier if we utilize our white label solution. So build the white label solution first, and then it's easier for us to use you. And then you might ask yourself, well, this all sounds great. You're building stock exchange, we're building an exchange 2.0, you're facilitating private market investments, but is there really demand for private market investing from a retail investor's perspective? And what we see is that we operate across 4 different asset classes. We've got corporate. Corporate means for us private equity, private credit, private debt. Then we have real estate that's separated in 4 different asset classes. We've got residential, we've got commercial, we've got hospitality, and we've got hospitality and healthcare. And then we've got infrastructure projects that are primarily focused on renewable projects, and collectibles that split across various asset classes, art, fine wine, diamonds, you name it. What we believe is that all of these asset classes are inherently inaccessible. So you need great access to them. The problem is, even if you get the access, you've got significant equity requirements to invest into them, and you need to build up the know-how. And then even if you have that, as mentioned, we need liquidity in the markets. And this is what a lot of the asset managers have understood over the years by the names of Blackstone, KKR, Apollo. It's number one, institutional capital has been the main driver for the growth over the years. Now they're looking into private wealth channels because people are starting to think differently. They need different portfolio allocations. They want to diversify their portfolios. And that way we believe that we need a single exchange, or we need a lot more exchanges in the end, just like we have in Europe across 480 MTFs today, to make these private market investments accessible to the retail investors. And what we can also see on the right-hand side is that there's actually great demand from those investors. So is this really a game changer? We believe yes, because when we look at the history of trading, we started off with floor trading. Floor trading started off back even after the 1820s. You used to be on the trading floor, you used to call out each other, you would settle the trades on the trading floor. Then, at one point, 1997, Deutsche Börse introduced Xetra, which is facilitating over 80% of all trades today in Germany. And what they've done is that they've actually introduced computer trading that is enabled to clear and settle transactions a lot quicker than before, and obviously match the various counterparties with each other. And now we've entered a new era, which comes to DLT trading. DLT trading, obviously reducing intermediaries, facilitating trades a lot more efficient by just, for instance, instant settlement, thereby reducing the risks involved in every single trade. And I'll get to the numbers in a second. So when you look at the various when you look at the value chain of a trade, you're looking at the primary market, looking at the secondary market at first. Primary market is the issuance side of things. I mean, today, if I was to issue a security, it can really take up to days, even after all the work. I need to print out the papers. All of that paper needs to be handed over to Clearstream. They need to then make it bankable. And on the other hand, if we look at the DLT market infrastructure, that can happen instantly. Secondary market trading, of course, the automation of trades is a lot more efficient. But I think what's really, really interesting is the settlement and the clearing. Because when we look at this, Roland Berger did a study on this, and what they've looked at, okay, what are the real cost savings when it comes to trading over the next 10 years? And that was a study formed in 2021, so they looked at a 10-year approach. And what you can see, and we're looking at mid-2025 now, is that we've already obviously experienced a lot of, through progressive regulation over the years, that some of these things, some of these cost savings, especially in the clearing place, and in the end, the price of risk are the two major drivers of why we believe that a DLT MTF, DLT-TSS, or a DLT-SS will have a massive impact on the capital market infrastructure of tomorrow. Because when you look at just the price of risk through the instant settlements, I mean, every single transaction that's settled today is T+2. T+2 is 48 hours. It takes a long, long time to settle these transactions. If we utilize DLT-based market infrastructures, we can settle them instantly, thereby reducing the risks significantly. Without digging into much detail, due to the time limits, the DLT pilot regime was formed in 2023, in March 2023. It actually came into place. The reason being is that I think on a European perspective, from a European perspective, the ESMA understood, okay, DLT will have a massive impact on the capital markets infrastructure. And if regulated and progressively regulated, it can have one of the greatest effects on the efficiency level of all transactions that are happening today. And what they formed is a pilot regime that is taking place, that anyone can apply for. Either your market operator, then you can apply for the DLT-TSS or the DLT-MTF, enabling you to trade, and maybe also then with the DLT-TSS to create the settlement system, and thereby obviously enhancing the cross-border expansion, having greater facilitation, and also having a European exposure. I think this is also one of the greatest things with this. It's a European regulation that has come into place, so you can really facilitate everything Europe-wide. Why I believe that anyone that's setting out to create one of these exchanges, I think there's 3 key components to this. Number 1 is the technical components. I think you need to have a strong technological team that actually understands financial securities, that understands the capital markets, and understands, obviously, the blockchain implications of those. Then, on a second level, actually the target operating model, all of the exchanges, is very similar to any bank out there. So you've got your front office, you've got your back office. I think compliance is one of the key things if you want to run one of these. And then on the third level, I think starting off, and this is obviously provided, and this is what I said back in the days, that's why we call it Finexity 1.0, we have issued over 160 securities in the last 4 years. We have over 10 trading partners, so financial institutions connected to our infrastructure. We've had obviously over 10,000 registered investors that have already traded on this. So I believe for us, this is the next important step to take by becoming even more regulated than everything that we do today on the primary market basis, and obviously providing more security to all the players that we cooperate with. So when we look at the ecosystem today, I think this is, we look at, okay, this is where we stand today. It's a lot of what we call island solutions. Why do we call them island solutions? Because from our perspective, these are ideas that are happening in the market, but they're treated really on a solo-to-solo trade basis. And you would have an issuer, you would then have a crypto securities register, so you would file your crypto security with them. You would then have a trading partner maybe that would then broker your security. And then you would obviously have someone that actually custodizes it. The problem here is where you're going to be trading these securities. You enable primary market, and then on a secondary market basis, when you're really looking at mass market adoption, and I think this is the major difference. When we look at the crypto space, where we stand today is mass market. When we look at any tokenizations, ideas happening over the last 4 years, there hasn't been mass market adoption as of today because of, number 1, the regulation wasn't there in place up until, or like it has been progressively regulated, but obviously with the Electronic Securities Act coming into place, one of the major game changers, now with the DLT pilot regime being another major event that happened, or like another major act that has been introduced. And now we can actually bring all of these players together on a single exchange to make these investments that have been issued over the years more tradable, trade them efficiently, and thereby providing the investors with greater market access. As mentioned, for us it's really, really important to have opened up our infrastructure. We don't believe in a B2C business model when it comes to the tokenization of assets. We believe that the market is ready to be cooperated with. We want to cooperate with issuers, we cooperate with custodians, we cooperate with trading partners. So we really want to bring everyone together and facilitate an efficient trading of the tokenized securities. My name is Paul. I've got my co-founder here today as well, Tim, our CTO. He'll be speaking at a panel discussion later on about real-world asset tokens. And then obviously we've got our head of growth, Oliver Becker, with us, and Moritz as well, and they'll be standing outside. Really happy to answer any of your questions. Thank you very much for your attention, and I'm looking forward to any other further talks. Thank you.